My name is Tando, and I serve as the Managing Director for Personal Trust, and it truly is my pleasure to welcome you here today, to say thank you for braving the weather to be with us this morning, and also just to say thank you for being our clients. So on behalf of all of Personal Trust, I want to express our deep appreciation for your continued support. Quite simply, as we often say, without you, we don't have a business. It is your trust in us across generations, through the market cycles, and over the long haul that is the reason that we're still here 45 years later doing what we love. So for us, today is about a celebration, not just of the performance numbers that you'll see a bit later, but also of relationships, also of resilience and the personal connections that have always been the hallmark of our business. We are proud to still be independently owned, and even prouder to still be personal. And some of you may be aware that in the last 12 months we were approached by a big bank testing our resolve and whether or not we're still for sale, or whether or not it was not for sale. And thankfully it was a very, very short decision, and we told them no. So really that is really important to us. We think that is our edge and our ethos, as I've said. Today, we're here just to share some insights, to introduce new leadership, and to reaffirm our commitment to serving you with care and competence. So let me introduce you to the people who will be taking you through the journey this morning. First up is Glenn Moore. Glenn doesn't need an introduction to most people in this room. Glenn is our long-standing investment director. Glenn has been instrumental in guiding Personal Trust's investment approach over the years, and he has helped build the robust foundations upon which our portfolios and client relationships rest. Some of you may know that Glenn is now in the process of stepping back to make more time for his family, but he remains very much a part of our team and will help us ensure a smooth transition and continued excellence. So please join me in welcoming Glenn, and thank you for his service over the years. Alongside Glenn is Monine Watson, our newly appointed investment manager. Monine is one of the country's most respected investment professionals with over 30 years of experience. Most recently, as the Chief Investment Officer of Old Mutual Multi-Managers. Monine brings a sharp mind, a steady hand, and a deep commitment to client outcomes. Monine will be building on the strong legacy that Glenn leaves behind, and we are all excited for what her leadership will bring for us at Personal Trust. Welcome, Monine. And finally, we are delighted to welcome Paul Stewart, who's seated far to my left. Paul is someone whom most of you will be meeting for the first time today. But like Monine, Paul has had a distinguished career in the financial services industry. And most of us at Personal Trust have known Paul for quite a long time. We were chatting yesterday that I'd met Paul for the first time, I think it was 2005. He was at a business called Plexus and has since led many businesses, serving most recently as a chief investment officer of one of the top investment management firms in the country. Last year, we had the opportunity to invite Paul to serve as a non-executive director on our ManCo, and soon after we joined, we found out that he was looking to change direction and really have a final destination in his career. And it was a no-brainer to us, and we quickly invited him to have that journey with us and join us as a trust officer. And Paul's decision to spend the next chapter of his journey with us reflects our ongoing effort to deepen our team and ensure continuity of the Personal Trust way. And most of you, when you meet him, you'll realize what I mean by that. And the Personal Trust way is built on values and relationships and thoughtful succession. So thank you once again for joining us this morning. The format of today is that we'll have the three speakers share some thoughts, and they'll cover different topics, but you'll see it'll all be brought together at the end and really share an investment journey that we think, and a story that we think is quite compelling for where we are today. After that, we'll have a few minutes to take questions, and also understanding that there may be some other topics that we haven't covered that are on your mind. We'll have an opportunity to do that. Then afterwards, we'll have some snacks and possibly an opportunity to have a quiet toast to what we've built over the last 45 years, and certainly to the many years that are still ahead of us. Thank you.
Good morning, ladies and gentlemen. When I joined Personal Trust in December 1988, the all-share index was trading at 2,000 points. Today, the all-share index is trading at 94,000 points. That means it's up 47 times since I joined in 1988. In money terms, if you'd invested 100,000 Rand in the JSE in 1988, today it would be worth 4.7 million Rand. So you might say, okay, well, that's quite a nice story, but everything's gone up since 1988. So I thought I'd have a look at a couple of items and just see what happened to them. So in 1988, you could buy 2 liters of milk. I'm not sure whether it was Woolworths, but you could buy 2 liters of milk for R2.75. Today, that same 2 liters of milk costs R34.99, up 13 times since 1988. You could buy a liter of petrol in 1988 for 95 cents. It used to cost me 5 Rand to fill my scooter. Today, that same liter of petrol costs you 21 Rand 40, 22 and a half times. So although petrol price and the milk price has gone up substantially since 1988, you'll see that the equity market has gone up a lot more. And that's the primary reason when we invest in retirement capital that equities are a critical component of delivering inflation-beating growth for portfolios. However, unfortunately, the equity market doesn't go up in a straight line. It's not 2,000, 3,000, 4,000, 8,000, 10,000. It's more like a roller coaster. And along the way, you have some very dramatic declines and some really nervous times, testing your resolve to remain invested in equities. In my personal experience, I wasn't around for the 87 crash, but I was around for the 1998 emerging market crash, when one of the East Asian countries, in those days, East Asia was a massive investment destination for the world, emerging markets. Mark Mobius, I don't know, you might remember flying around on his airplane, making investments in Thailand and here, there, and everywhere. The Thai baht started to collapse in 1998. And South Africa was introduced to the first time to the global world of finance. We never had a financial rand to protect us. The financial rand had been abolished by that stage. And when the Thai baht started to get smashed, the rand started to get smashed, our equity market came down heavily, 45% down at the worst point. And South African government bonds traded up to 25%. And it was quite a nerve-wracking, well, it was a very nerve-wracking time, but also it was relatively unexpected because our market was not trading at a very high price earnings ratio. There were reasonable dividend yields around, but it was an event that took place in some other part of the world, and suddenly everybody was heading for the door in terms of emerging markets. And we only found out later, or during the process of the crisis, that there was a business in the United States of America called long-term capital management that were borrowing dollars and investing those dollars in emerging markets, getting a much higher yield. And that worked fantastically while the emerging market currencies were stable. But when the emerging market currencies collapsed, they had to head for the door. And at that particular time, the United States was in a process of raising its interest rates because the economy was starting to overheat. And I remember having a chat to a very senior fund manager in London at the time, and he was saying, there's no way the US is going to reverse course. Well, within a matter of weeks, suddenly long-term capital management was in trouble, but then also, so too, were all the banks that had loaned money to long-term capital management. And so there was a liquidity crisis in the United States. They dropped their interest rates dramatically, and that resolved the crisis, but it led to the next semi-crisis, which was all that liquidity was pumped into the system. It caused the, what do you call it, the 2000, remember when we all converted our computers to the new system, and you had that massive boom in IT shares. The next crisis was 2008. That was a global financial crisis. That was property-led. It was subprime. Those are words you might remember. And once again, in that particular crisis, the story was it was a banking crisis. Subprime loans had been created. I remember reading an article at the time, some young fellow of 30-odd years old owned 17 properties or 7 properties in a place in the United States I hadn't even heard of, and he had no intention of taking occupation. He was merely buying them to flip them onto the next buyer. That was a sign that this subprime was out of control. And as a result of the subprime crisis, we had Bear Stearns get into trouble, we had banks in the UK get into trouble, and then the straw that broke the camel's back when the Federal Reserve and the Treasury decided to let Lehman Brothers go. And when they let Lehman Brothers go, suddenly there was contagion throughout the banking sector in the United States of America, and there had to be a massive rescue attempt in order that the markets could stabilize. The last crisis that I've been through is not this latest one, it's the COVID crisis. And of course, that was something that was completely unexpected, a 1-in-100-year event. It wasn't a banking crisis, it was a policy-induced crisis where governments around the world decided to shut the economy. And the world is currently still dealing with that because budget deficits, because governments handed out free money, because of that, budget deficits rose very dramatically. And as a result, bond yields have risen fairly dramatically as well around the world. But 1998 came, and with the equity market down 45%, and with bond yields having raced up to 25%, there were significant capital losses on living annuity portfolios. I had to sit in front of a client who'd invested his hard-earned pension, 40 years worth of hard work, at the beginning of 1998, and by September of 1998, I think it was, that pension fund had declined by 20%. So a very sobering discussion. It's no good telling somebody that your pension fund is down 20%, but the market's down 45%. It doesn't make you feel any more comfortable. I'm delighted to say that that client is still a client today. He's 87 years of age. His pension fund has grown significantly subsequent to that. He continues to draw a very nice income from it, and his children will be able to inherit a substantial sum from that. The secret there was he didn't panic. And when you go through these crises, it's very, very important. Equity markets go up, but they also can come down very dramatically. As a result of that crisis in 1998, I spent a lot of time thinking about asset allocation, trying to find assets that were not all exposed at the same time to the crisis that took place. So you have to have equities in your portfolio. You have to have bonds. Generally, bonds protect you, but in that particular case, they didn't because of the long-term capital management situation. But there are other instruments as well that you can use. And so we've evolved the portfolio to include not just equities and bonds, but inflation-linked bonds, which are now something which is less correlated to equity market movements. We introduced gold, because you can buy new gold on the Johannesburg Stock Exchange. We introduced dollar cash. We introduced dollar bonds. We've introduced dollar equity. And so we've broadened the assets that we can hold in the portfolio. And as a general rule, over the last number of setbacks in the market, that diversified asset allocation that we've implemented has helped us in the drawdowns, and has helped me not to have too many more conversations with someone who's lost 20% of their pension fund, because it's a very sobering conversation. We worked with Equities, who had a massive database at the time, to build these models on an inflation plus return. So they put all the data that we asked them to put into their models. They run these models, and they determine with a degree of probability what is the likelihood over a 3 or 5 year period that that particular mix of assets will deliver an inflation plus 3 or an inflation plus 5 return for the clients. And we've had to adapt that model over time because remember, a lot of the data goes back right to 1960, but the South Africa today is quite different from the South Africa in 1960. We don't have the financial rand anymore, so you've got to take that into account. We didn't have inflation-linked bonds back then. You've got to take that into account. We've been through a number of different crises. We've had prescribed assets. There were prescribed assets back in the day. We don't have prescribed assets anymore. So you've had to build all of these different events into your model in order to try and build something which you can feel confident in will deliver the returns that you're looking for. My time of doing that hands-on each and every day is coming to an end. And I'm delighted now to hand over to Menine. Menine is a very experienced fund manager. She comes from Old Mutual, which is a great school of investment. And I have absolute confidence in her ability to continue to deliver inflation-beating returns for our clients. Over to you, Menine.
It's lovely to be here. I've been with Personal Trust for just under 5 months, and it's great to eventually meet the client that sits behind the assets that we manage. So today I want to speak about the investment principles that Glenn has already started speaking about, but just in a bit more detail that embed our thinking in the way that we manage the funds. And I thought I would use Warren Buffett. He was in the news very recently, because at the age of 94, he's announced that he will eventually be stepping down as the CEO of Berkshire Hathaway, a company he's been running for more than 60 years. He's already been called the greatest investor of all time, given the stellar returns he has generated for investors over many decades. But for all his fame and fortune, he was a man that liked to keep things simple and had a lot to say about investments. But I was intrigued when I was looking at his different quotes that he also had a lot to say about how you live your life. And I love this quote because it's not one that one expects coming from an investment guru, where he said, "The happiest people do not necessarily have the best things. They simply appreciate the things that they have." So it's a clarity of values across his life. And in the time that I have been at Personal Trust, I've come to sense some similarities. When I speak to John and some of the founders, it's always about keeping things simple and keeping the client at the center of what we do. And from an investment perspective, that is about delivering on the investment outcomes that we have set for the different products that we manage for you. So I want to speak about these principles and how we manage the funds in more detail, and I'm going to do that using some of the Warren Buffett quotes. So this is probably one of the ones he's most famous for, where he said, "The first rule is not to lose. The second rule is not to forget the first rule." So yeah, he wasn't talking about volatility because, as Glenn said, you're never going to get rid of that roller coaster in markets. But he was talking about trying to avoid capital loss and permanent loss of capital. And so how do we think about that? Well, we try to keep things simple and firstly invest in asset classes that we understand. And it's also about investing in asset classes that offer value. And I'll speak to that in a bit more detail later. And then if you want to build robust portfolios, it's about diversification. Again, Glenn has touched on this, but one has the ability to diversify between growth and income assets, and also between local and offshore. Gives one an ability to build robust portfolios that can weather a lot of the volatility that happens in investment markets. And then from a client perspective, it's about differentiated solutions to manage your outcomes and expectations. And then Warren Buffett is also known for being very direct. He said, "An idiot with a plan can beat a genius without a plan." And that is about knowing what you want to achieve and how you're going to achieve that. So we're very clear about what we want to achieve. We've got two sets of products. The Personal Trust Conservative Managed Fund that targets inflation plus 3. So that is the foremost thing that we are trying to achieve with that fund. And then if you look at the Managed and Prudent Fund of Funds, these funds have a higher target, trying to beat inflation plus 5. So that is always what we come back to in terms of have we achieved those targets for clients, because over time it's about building your real wealth and beating inflation. And then it's important to know how you're going to do this. And we have important guardrails in the form of benchmarks. Glenn also spoke to that in terms of understanding what asset classes have delivered over the long term and how you should combine those assets to achieve those inflation plus targets. So it's understanding the objective as well as the risk constraints. And then the next quote, he said, the stock market is a device for transferring money from the impatient to the patient. And I'm sure you know friends who at the very worst time in the market just lost confidence when things were going badly and just moved into cash. But it's the people who can be patient that will see their investment objectives being met over the long term. So it's this need for patience and a long-term perspective. And even in one's retirement years in investments, you're going to have that. It's because it's important to choose the right fund. And in many of your cases, that is actually going for inflation plus 5. And with that will come a certain amount of volatility. So how does one keep a level of perspective? We just think of this here in South Africa. We've had 3 budgets. We've wondered whether the government of national unity is going to survive. We've had tariffs overseas, and there'll always be something to worry about. But this quote from Warren Buffett about America is surprising because we often think of the US, maybe until recently, as being more stable. So he said, in the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. So it's about having the perspective that there will always be volatility in the short term, but one has to keep your eye on the long-term target. So having said that we have a plan, we try to build robust portfolios and keep a clear mind in times of crisis. How have the funds actually done relative to those targets? So I can't stand anywhere near these screens to try and point, but I hope you can follow what we're trying to kind of cover in the slide. In terms of the delivery of the fund under Glenn's management, we've had a long history of delivering to clients' objectives. And then I think if I speak to people, we often as investors talk about, buying instruments that offer value, and people often think, well, what does value actually mean practically? So again, another quote where Warren Buffett says, price is what you pay and value is what you get. And it's about not focusing on short-term swings in price, but focusing on the underlying of the investment. Now, if you look at this chart, you can see the dark black or blue bars are quite consistent around, almost a 9%, 10% return over time. And that's the yield that SA bonds have delivered. So it's moved around between 9 and 11%. But that yield is what you get every year. And that's the value that we see in South African bonds. So a good example of value, but we know that bonds are not cash. So they've got a longer duration, they come with volatility. So there's some years where you're going to have a capital loss, and that's the red parts of the bar. And then other years, like last year, with the confidence that came with the formation of the government of national unity, you had a massive capital gain and a return of about 17% from the bond market. But it's that interest that offers you the value and offers you a buffer against the bad times, and then the potential to also do well when sentiment improves. Moving on to the South African equity market, I've got annual returns in the chart from 2003 and until this year. And if you look at the earlier years in the early 2000s, I mean, Glenn was talking about 1998 with the crisis, but as we moved into the 2000s, we had a commodity boom. Our market did incredibly well. And there were many years where we got close to 20% in returns and even substantially above that. But if one looks at the more recent bars, you can see that consistency isn't there. You might also be surprised, why have I highlighted some bars in red when they're actually positive? That's to highlight returns that didn't make inflation +5. So equity is the growth asset in your fund and will drive that, higher inflation target. So very important that you're getting at least inflation +5. But after the Zuma years and the deterioration we saw in growth in our economy, sentiment towards our markets deteriorated, the valuation dropped, and while companies still did relatively well, you can see the impact that has had on the performance of the stock market. So I suppose the question today is, where is the opportunity in our stock market? And there are three things that I want to highlight that gives me a bit of optimism around the ability of our market to generate those growth returns going forward. The first is that the price-earnings ratio of the market has come down, pricing in, the lower growth that we have had for a number of years in South Africa. And then the second point might be more contentious. I mean, this year we had a growth forecast of close to 2%. That's already been downgraded, closer to 1%. But I do believe that the reforms that the government is trying to implement, if we can gather some pace with that, will eventually start supporting growth by improved infrastructure. So there is an understanding, and I think with all the, the insecurity we've had with the budget and that this year, that we really, to deal with the debt problems in our country, and we need to get growth going. So that will be a very positive for our market. And then lastly, as investors in South Africa, we're very lucky that we have a market that is incredibly diverse. So if you look on the right-hand side, it's a group of shares on our market that I've called SA Inc. And these are exposed to growth in South Africa. It includes the retailers like Pick n Pay, Shoprite, Foschini, the large banks, property companies, everything that is exposed to being in South Africa and the South African consumer. And those companies did very well last year after the election and the formation of the GNU, as a positive sentiment arose that we would have better growth in South Africa. This year, with what we've seen, those shares have lagged somewhat. But this year we've had our mining companies that have come to the fore. So we've got diversified miners that mine diversified minerals, and gold and platinum companies. And the gold and platinum companies have had stellar returns this year as gold has continued to go up and the price of platinum has improved. And then while we are a local stock market, we are also fortunate to have a lot of global companies listed on our exchange. So Anheuser InBev incorporate SAB, so that's listed on our market, British American Tobacco, and then a big luxury company like Richemont. So we diversifying growth in South Africa, and the SA Inc. companies with these global companies that are also listed on our market. And this year, they've also done a lot better. And then South Africa is not a company that's a big tech destination, but we have exposure to technology through Naspers that's invested in a big Chinese company called Tencent. And that exposure has done, really well on the South African market for a long period of time. So reasons to be optimistic that South African equity can deliver for investors going forward. And then opportunities also abound globally. In the graph, the different colors and the different sizes show the size of countries' contribution to global growth. So you can see on this chart that the US and China are the biggest economies globally. If you look at South Africa on the bottom right, we only make up 0.4% of global growth. So very small in a global sense. So it's important that we are able to invest globally, the opportunities of growth in different companies, but also exposure to countries and exposure to world-class companies in those countries, and exposure to sectors that we don't have here. So South Africa doesn't have exposure to the big tech giants globally, and investing offshore gives us that ability as well as to big pharmaceutical companies. So it's really ability to diversify risk and the opportunity for growth. And then some of you might be thinking, but what about the tariffs and what is happening globally? This is a great chart that I found in a coronation presentation where they showed, the different parts that make up the Boeing 787. Now, Boeing is an American company, and in the chart you can see all the different components that make up this enormous plane. And then what has been circled is the countries outside of the US where those parts come from. And one can see many red circles on that chart. So it takes a globalized supply chain to build even a plane that is made in the US. So globalization, and this is just an example of one business, but I mean, we could bring up many different businesses where this is very similar. And globalization has resulted in these integrated supply chains. And even though there might be calls for countries to re-industrialize even to a small extent, that's going to take a long time. So tariffs are with us. April was a month of, a lot of volatility in terms of where tariffs would land. And this weekend, Trump was saying, he's going to push up tariffs on the EU, and that's come back down again. So still some volatility, but I think there is a consensus view that tariffs will land at about the 10% level, which is still much higher than where we were at the start of this year. But companies are innovative, they face obstacles and struggles along the way, and will be able to deal with this increase in costs. So we still find a lot of opportunity investing in global companies. I just want to end off with how the funds are positioned and how we look at risk and exposures differently across our different products. So I've highlighted the equity and global in yellow. I think it's come up slightly green on your side, like a lime green, but it's on the right-hand side of each of the pie charts. And then South African fixed income in the different shades of blue. So we have the opportunity to invest in cash, which we'll see today what happens with interest rates, but cash is still delivering really high real returns. I've spoken to the value in bonds and then also value in inflation-linked bonds. And then the darker green is the exposure we have in the funds to global bonds and global cash, which offer unique diversification benefits for the funds. So if you look at just the colors overall, you can see that we have a good mix of local and global. We've got less equity exposure in the conservative fund, targeting a lower inflation plus return. But across the funds, we have more in local fixed income than global fixed income, just given the high yields that are on offer in our market. But it just speaks to a diversification across the products, and that each product is managed according to its mandate. So just ending off from me, we aim to stick to our plan and keep things simple, keep the diversification that I've showed in the previous chart, and then to exercise patience in times when there's extreme volatility so that you are rewarded with the returns that asset classes can deliver over time. Thank you very much.
Thank you, Monine. Greetings, everybody. It was a great honor for me when I was asked to address the clients of Personal Trust at this event. I am the newest recruit to the organization, so it wasn't expected. But as Thando said earlier on, my association with Personal Trust does go back many years. I've known John and Musa LaRue since the late 1980s. I first met Glenn Moore when he still had hair. And Thando was a fresh a university graduate from UCT, having completed a business science degree, when I was asked to assist Glenn and Jackie in the establishment of the personal trust unit trust management company. I think it was in 2003 or 2004. And it's been amazing as a practitioner of investment management from the outside, watching the evolution, the development of this business over the last 20 years. And from my side, it's amazing to be able to meet some of you today, and also congratulate my colleagues on building an incredible business. It's got such a strong brand and respect in the marketplace. So I've been asked to talk a little bit about the value of good financial advice. And I think to a large extent, that depends on the concept of confidence and trust. Because we sell a product and service that's delivered sometime in the future. Unlike buying a motor car where you can go down to the local dealership and you can test drive it and you can get into your car and you can smell the new leather, the benefits of that purchase are immediately apparent to you. The service that we provide, you only become aware of its benefits a long time into the future. And there's a big gap of trust and different circumstances that you experience along the way. And so for me, the idea of confidence and why you should be confident in our business continuing into the future is incredibly important. I think the key thing that we do as a business is to try and bridge the gap between the outcome that you expect when you sit down with your trust officer and he produces a financial plan and gives you some indication of what things are going to look like in the future, and actually delivering on that outcome when you reach that destination in the future. And I think that's really the main purpose that we serve as a business. So you ask yourself the question, what inspires confidence? What has given rise to you choosing personal trust as your service provider? There's many others out there. Why has this company been so successful? I think there's a couple of ingredients. The first one is that you have to have people. We're a people's business. We don't make widgets. We've got people that have got knowledge and specializations in certain areas. And we've got people that are incredibly knowledgeable about financial markets. Glenn, Marnine, and their respective teams. Retirement planning, we've got an amazing array of trust officers. I've met a group of people that are so skilled and so dedicated and so knowledgeable in their areas of expertise. Renetta and her team in the trusts and fiduciary department and our tax experts. So incredibly knowledgeable people, highly skilled in their areas of expertise. But having knowledge is one thing. You've actually got to be able to implement that knowledge consistently over time. And I think we've got a very good way of making sure that we convert our technical knowledge into practical use for people. So converting that knowledge and implementing it in time is critical. And those two things in combination produce a certainty of outcome. And we've had many clients. Glenn spoke about his investor that invested in a living annuity. A lot of thought went into do we use a living annuity as a product? It was a new product at the time, and I think there was a lot of discussion in the industry about whether it was a good idea or a bad idea. I think in history will show it has turned out to be an incredibly good product. But that certainty of knowledge with the skills that we have in the business, I think has been something, a hallmark of personal trust over many years. And as once again, from a person that was outside the organization, it was always revered and had a high degree of trust. And ultimately, trust is what we do. It's in our name. But I think this quote from Warren Buffett, I've also got a Warren Buffett quote. You can't be in the financial services if you don't have a Warren Buffett quote. But I think this one is, for me, one of the most important ones. Because we trade in the business of trust. And I think the image that this creates in your mind is just so powerful. Trust is like the air we breathe. When it's present, nobody really notices. When it's absent, everybody notices. I'm going to talk a little bit about what Glenn and Marnine both discussed, but in a little bit more depth. Because at the end of the day, bridging the gap between your money and your retirement needs and constructing portfolios, we have to assume some degree of risk. And I think practitioners of investments, we think about risk from a statistical point of view. It's statistically the standard deviation of returns, the semi-variance of returns. But that's not the way clients, lay people experience risk. If I had to ask you, what do you mean by investment risk? You would say, I invest 100,000 Rand into something and it's only worth 90,000 Rand somewhere down the line. I see a lot of people nodding their heads. And what you're really identifying there is the fear of the permanent loss of capital. So risk generally has negative connotations. When we speak about risk, people go, oh, I don't want to lose any money. I'm giving you my money. I want you to look after it. So I think that I would challenge that thinking a little bit to the extent that risk is part of our everyday life. You take a risk by getting up in the morning and walking down the flight of stairs in your house. There's a risk inherent in doing that. There's a risk inherent in getting into your motor car and driving to the supermarket. What we have become good at is managing that risk. So instead of having a flight of stairs with no support, you've got a handrail so that you can help yourself down the stairs. It mitigates the risk of walking down a flight of stairs significantly. In a motor car, you've got an airbag, you've got a seatbelt, you've got an insurance policy in the event that you do have an accident. We mitigate those risks that we experience in our everyday life. And investing is no different. In order to achieve the types of returns you require to keep the purchasing power of your money intact over time, you have to assume some market risk. What we don't want to do is assume the permanent loss of capital. We want to assume temporary volatility, the semi-variance of returns, and that's how we distinguish ourselves in terms of producing the outcomes for our clients over time. So I'd like to discuss very briefly two types of risks, and there's a wonderful book written by a gentleman named William Bernstein in 1996 entitled Deep Risk, Our History Informs Portfolio Design. And I think he breaks down this notion of risk in a very easily digestible way for most people. So the first type of risk he talks about is what he calls deep risk. And in fact, he in his book only spoke about the first four there: inflation, deflation, confiscation, and devastation. I've added a fifth one, bit of poetic license, bankruptcy, because that's I think fairly obvious. But I think inflation, we all know inflation is the relentless depreciation of the purchasing power of your money. So 100 Rand today can't buy you the same as 100 Rand in 5 years' time. You get half the basket. Deflation is the decrease in prices, and deflation generally refers to the deflation in the price of capital assets. A good example of that right now is if you've owned a property in Johannesburg, any property owners in Johannesburg here, you'll know that a property you purchased 20 years ago, you actually can't get what you paid for a property 20 years ago in Johannesburg right now. That's deflation. Typically it affects capital values, and once that happens, that loss tends to be fairly permanent unless something significantly happens. Confiscation. So governments can confiscate your assets. So whether it's the Argentinian government defaulting on their debt and not paying bondholders, or whether it's land grabs a la Zimbabwe, confiscation can lead to the permanent loss of capital. And then devastation, earthquakes, fires, volcanoes, those types of natural disasters. Once those things happen, capital can be permanently destroyed. Bankruptcy is, I think, pretty obvious. I think we all understand the concept of a company or business that goes out of business. If you're a shareholder in that business, you can permanently lose your capital. Of course, all five of these things should be avoided at all costs. And we try our level best to make sure that when we invest your money, we avoid permanent loss of capital. The second type of risk that Bernstein talks about is shallow risk. And this is just the normal capital volatility, the normal price increase, decrease that markets display over periods of time. It's nothing to worry about. It maybe leaves you feeling slightly uncomfortable at periods of time. Glenn spoke about the 40% or the 20% decline in his clients living in UAT. They had to have an uncomfortable discussion with him. But with the fullness of time, volatility actually becomes largely irrelevant. So we're trying to avoid permanent loss of capital. We have to assume capital volatility, it's the byproduct of investing in risky assets if we want to achieve inflation-beating returns over time. The amazing thing about investing is that there's this paradox that exists between what makes you feel comfortable versus what you need. Because the assets that make you feel most comfortable, the low-risk assets, things like cash and to a lesser extent government bonds, display low levels of capital volatility. They make you feel good at night, but they display very high levels of deep risk, permanent loss of capital. Why? Principally inflation. So if you don't take, after the effects of tax, your cash does not grow sufficiently versus inflation. And so you will arrive at a point, a very comfortable ride into the future, and you'll invest yourself poor. So that's the paradox. These low-risk assets display the highest levels of deep risk, whereas the high-risk assets display the lowest levels of deep risk, but the highest levels of shallow risk. So my message to you today is assume the shallow risk, close your eyes, ask your trust officer to come and give you a hug when markets are down, but whatever you do, do not take your money out of the market. It's our job to assume and manage that shallow risk to beat inflation and to avoid the deep permanent loss of capital. And I think Personal Trust as a business has done that very well over the years. So just to conclude, how do we avoid deep risk? We do it in two ways. First of all, at an advice and a product level, portfolio level. So we're generally conservative as a business. We approach advice, portfolio management, and all those areas of expertise with a great degree of conservatism, really to try and avoid the potholes that exist along the way. The risks are managed very strictly and very carefully per portfolio. So you know that if you're in a low, medium, or high-risk portfolio, you're there for a reason, with a particular time horizon and volatility attached to it, and we make sure that those portfolios are managed in those volatility and risk bands through time. A very thorough analysis of our products and partners. So whether it's an administration partner like Allan Gray or 91 or Glacier, or any other product provider that we use, we make sure and do a lot of work around, is that company going to be around? Are they going to disappoint us in any way? Is there any risk of a permanent loss of capital? But also then financial markets and the types of securities that the investment team choose to hold within the portfolios. And then finally, just as a general comment, I mean, we are a fairly conservative, valuation-orientated investment management company. We apply that logic to asset classes and also to diversification. And then the second layer of risk management where we avoid deep risk is through the legal structures and the governance of the company. So I think Personal Trust, it's always interested me, and I'm honored to be a non-executive director of the unit trust management company. Personal Trust has got a very high level of corporate governance for a company of its size. It's the type of corporate governance you would probably expect to see in a listed company. And that's quite unusual in the type of industry that we are involved in. It's got independent directors on its board, it's got an audit and risk committee, and those things are very important in making sure that there's an independent set of eyes on the executives of the business, making sure that they're doing the right thing on an ongoing basis. The second area, I think, is you probably are aware of that term of a unit trust. Technically, the word these days is collective investment. They're used interchangeably. But a unit trust is the safest investment vehicle, in my opinion, that money can buy. And the reason for that is that a unit trust has got so much protection and investor protection and scrutiny built into it. There is, first of all, the assets of a unit trust do not sit on the balance sheet of the company that manages their unit trust fund. The assets are completely remote, so they sit on independent, that's why it's called a unit trust. They sit independently from the company. And those assets are controlled by the custodians and the trustees of that trust. So when the investment team make an investment decision, when the administrators give an instruction, 3 sets of eyes look at every transaction. It's the person initiating the instruction, but also independent trustee and custodian. All 3 of them have to agree before those assets or cash can move anywhere. So a unit trust is an extremely safe, well-regulated investment vehicle, and almost all the assets that are caught within the personal trust business sit within a unit trust some way or the other. And then finally, we've got our own independent auditors that look after the business, and we've got independent regulatory oversight from the FSCA, and the business has been through several audits, and they've always been spotlessly clean, which is amazing. So in conclusion, I think Personal Trust has been in the business for 45 years. It's served its clients, I think, with distinction, and I'm really thrilled to be in the business. I think hopefully I've given you some insights today into how we manage risk, and I look forward to meeting all of you in the years to come, and I can see no reason why Personal Trust is not another 45 years of great success ahead of it. Thank you very much.